senior exploration manager told me early on, you're not a real geologist until you've had a couple of redundancies. Now, he wasn't wrong. And through all of that, from the WA outback to the Central African copper belt, I kept noticing the same thing. Most investors were reading mining announcements completely the wrong way. Today, I'm going to show you how a geologist actually reads them and the process I use to decide whether a stock deserves my time. I'm James Cooper. I spent 15 years as a geologist before I ever seriously considered investing. I worked for majors and juniors across Australia and overseas. Drove out into the bush at dawn to log drill core, survived mergers, takeovers, and more redundancies than I care to count. Now I'm a commodities analyst specialising in Australian mining stocks. Here's something you need to understand. About 9 out of 10 ASX mining announcements contain exclusively positive news. No real risk disclosure, no probability of failure, no mention of what didn't work. Now that's not an accident. Exploration companies live and die on investor attention, and hundreds of small cap miners are competing for the same capital. So they present data in the best possible light. That's the reality. As a geologist, I spent years interrogating data, working out what actually mattered and what was just noise. And that's a big part of the job. It's also why serious investors hire geologists and engineers, because you can't rely on reports alone. You need someone who can read behind the spin. Now, that's what I'm going to help you do. When a mining stock crosses my radar, I check 3 things immediately. First, the commodity. Is this something the market actually needs? Copper, gold, uranium, rare earths. These matter because supply is tight. Second, the jurisdiction, Australia, Canada, the US. These attract capital, full stop. Strong regulation, solid infrastructure. I've worked in places without those, and it changes everything. Third, scale potential. Small deposits don't excite markets. What matters is how big something could become. If a project has district scale potential, it keeps investors engaged, keeps news flow coming, and that's what builds long-term uptrends, not just short-term spikes. And that's where the real money is made. Once it passes that first filter, I go to the geology. And this is where most investors fall short. They see a headline grade and stop there. But grade is just one piece. You need to look at depth, strike length, host rock, structures, veins, geophysics, soil anomalies. All of it matters. Companies will often highlight one positive signal like alteration. That alone means very little. You need everything lining up. Right host rock, right structures, faults, shears, strong soil anomalies, including pathfinder elements. When those pieces come together, you have a real shot at discovery. And as an investor, that's when you position early, not after the result. Because sustained winners are built on real geology. Now, let's talk about JORC. This is the reporting framework that governs everything. One key rule is drill spacing. You can't drill 2 holes 200 meters apart, hit gold in both, and assume everything in between is ore. JORC creates a level of certainty, but it's still written in technical language, and geology isn't exact. So there's still some room for interpretation. When I assess a project, I ask 3 quick questions. Do they have a real JORC resource or just a concept? Is there a path to production, studies, infrastructure, progress? And most importantly, who's running it? Because in this industry, talent is scarce, and the people involved often determine the outcome. Now zoom out, the setup today is very different. The downturn from 2013 to 2019 was brutal. Not just a downturn, a wipeout in exploration investment. Experienced geologists couldn't find work. Universities shut programs. People left the industry entirely. But demand didn't stop. Populations kept growing. Cities kept expanding. Commodity demand kept building quietly. There's also a time lag. It takes 10 to 15 years to move from discovery to production. And that's assuming discoveries are even being made. Yes, you'll hear about green energy, reshoring, global growth. Those matter. But the real driver is supply scarcity. Years of underinvestment at the worst possible time. Now, I watch copper closely. It recently broke past its 2011 highs. And that matters because when price moves into new territory, it often signals something much bigger. Before going deeper, I check the numbers: market cap, cash, shares on issue, funding requirements. Junior miners burn cash. If a raise is coming, dilution is coming, and that changes everything. But a well-funded company with clear milestones, that's different. That's when the market starts paying attention. That's when re-ratings happen, then the catalyst. Mining stocks don't move randomly. There's always a reason: drill results, resource upgrades, feasibility studies, takeovers, commodity price moves. If there's a clear catalyst ahead, it's worth a closer look. If there isn't, I move on, because time is the edge. There are hundreds of mining stocks. Most deserve less than 60 seconds. Knowing which ones don't, well, that's the skill. So when a stock crosses my radar, this is the process. Right commodity, right jurisdiction, real scale potential. What does the geology actually say? Who's running it? Does the capital structure make sense? Is there a catalyst? And if it passes, it gets a deep dive. If not, I move on. Now, I've spent 15 years in this industry across the field and boardrooms, and the difference between good investors and bad ones isn't access to information, it's focus. That's what I'm here to help you with. If you want to go further, join my free e-letter, Mining Memo. That's where I share this kind of analysis regularly. You can join for free. Just hit the link in the description.